While everyone was busy staring at price charts, something huge happened in complete silence. No press conference, no breaking news, no viral headline. A tiny rule, buried deep inside the global banking system, was quietly adjusted. And history shows that when the rules defining safety, risk, and collateral change, money always moves. The biggest financial shifts don't start with a bang. They start with a whisper. For more than a decade after the 2008 financial crisis, regulators asked one single question over and over. How do we stop the system from breaking the next time stress hits? The answer wasn't a new product or another bailout plan. It was regulation. Slow, technical, and honestly, boring to most people. But absolutely decisive. This framework is known as Basel III, and it was designed by the Bank for International Settlements, the institution that coordinates the central banks themselves. Now, Basel III isn't some dramatic overnight switch. It's a long, gradual process that tightens how banks measure risk, how much capital they have to hold, and what actually counts as high-quality collateral. The goal is simple. Make sure banks can survive major shocks without freezing the entire global economy. To do that, regulators focused on leverage, liquidity, and the real quality of the assets backing trillions of dollars in obligations. And this is where gold re-enters the story, not as hype, not as a conspiracy theory, but as simple balance sheet mathematics. For decades, gold sat in a regulatory gray area. Central banks held it, of course, but commercial banks were actually penalized for treating it as a core asset. Under the new Basel III rules, physical gold held directly and properly allocated can now qualify as a high-quality liquid asset. Now, this doesn't force banks to go out and buy gold. What it does is remove a structural disadvantage that once discouraged them from holding it. So why does this matter so much? Because modern finance runs on leverage, and leverage only works when the collateral backing it is trusted during a crisis. Every major financial crisis in history has shown us what happens when that trust evaporates. In 1929, stocks collapsed under borrowed money. In 2008, mortgage-backed securities were treated as perfectly safe until, suddenly, they weren't. Even in 2020, the Treasury market itself briefly seized up when liquidity vanished. Regulators learned a very hard lesson. Paper structures fail under pressure. The quality of your collateral matters infinitely more than clever financial engineering. Basel III reflects that lesson. It discourages excessive short-term funding. It reduces tolerance for opaque, hidden risks. And it raises the cost of running those huge leveraged positions that only work in perfect market conditions. This does not guarantee that any asset price will go up. Anyone who tells you that is wrong. What it does is change incentives. Markets don't move on opinions. They move on incentives. When capital becomes more expensive and leverage becomes less forgiving, institutions adapt. They have to. They reduce risk. They simplify their exposure. And they start to favor assets that stabilize their balance sheets instead of amplifying volatility. History shows us exactly how this plays out. The banks that survived 2008 were the ones that had strengthened their capital buffers and reduced their reliance on fragile funding models. The banks that failed were the ones that relied on extreme leverage that collapsed the moment confidence disappeared. Gold didn't cause survival or failure, discipline did. Basel III is all about enforcing that discipline, not rewarding speculation. Now, we have to be honest about silver, which often gets pulled into these narratives. Silver is not classified as a top-tier banking asset under these rules. Its role is primarily economic, not regulatory. Silver tends to do well in inflationary growth cycles and performs poorly in deflationary shocks. In 2008, silver collapsed right alongside other risk assets. Anyone claiming guaranteed outcomes for any asset is simply ignoring history. The real lesson here isn't about buying one asset or selling another. The lesson is structural. The era of unlimited leverage built on weak assumptions is gradually ending. Capital rules are tighter. Liquidity is less certain. Risk is being repriced across the entire system. This new environment rewards resilience, real cash flow, and strong balance sheets. It punishes blind leverage and bets made on a good story. Smart investors don't chase dramatic headlines. They watch the rules, the incentives, and the constraints. They ask, what's becoming harder to finance? What's becoming more expensive to hold? And which old assumptions no longer hold up under stress? Basel III answers those questions quietly, without any fanfare. In 1971, the world abandoned gold to expand credit. In 2008, that very credit expansion nearly destroyed the system. The response wasn't a return to the past, but a necessary correction toward discipline. Basel III isn't a gold standard revival, it's a stability standard. When the foundation of the financial system shifts, the loudest voices are rarely the most accurate. The real winners are those who understand why the rules changed, how incentives are realigning, and where risk truly lives. Because in finance, the biggest moves never begin with noise. They begin with rules, and those who understand them are the first to position themselves. Thanks for watching, and be sure to subscribe for more insights.